July 1, 1944. Bretton Woods, New Hampshire. Delegates from 44 nations signed the Articles of Agreement. The United States dollar was crowned king of the world. Backed by gold, pegged at $35 an ounce. The new global reserve currency. For the next 27 years, that promise held. Then came August 15, 1971. 8 p.m. Eastern Time. President Richard Nixon addressed the nation. He severed the dollar's last link to gold. The Nixon shock. No more convertibility. A pure fiat system was born. The global financial order entered uncharted waters. That was 1971. That was year one. Today, 2024, the fiat US dollar system has entered its 80th year. History has a stopwatch, and it is ticking. For every dominant empire, for every global reserve currency, the lifespan is not a mystery. It is a pattern, a measurable, predictable, and brutal countdown. The timer always stops at 94. This is not a theory. It is historical fact. This is the story of the 94-year currency life cycle, a pattern that has destroyed every single global reserve currency in modern history. From Spain's silver real to Britain's pound sterling, the pattern is a five-stage death spiral. It begins with a promise of absolute dominance, and it ends with economic collapse, geopolitical irrelevance, and a new king on the monetary throne. We have identified the 5 irreversible stages. Stage 1, the golden anchor. The currency is born from crisis, backed by real value, and ascends to global dominance. Stage 2, the Imperial Overstretch. The issuing empire expands militarily and financially, funding its ambitions with debt denominated in its own currency. Stage 3, the Fatal Decoupling. The link to tangible backing, gold, silver, real assets, is severed. Faith alone remains. Stage 4, the debt spiral. To maintain the empire and domestic peace, money is printed. Debt explodes. Inflation becomes structural. Stage 5, the collapse of confidence. Foreign holders flee. Geopolitical rivals challenge. A new system emerges from the ashes. The life cycle from Stage 1 to Stage 5? 94 years. On average, the Spanish silver cycle, 1590 to 1684, 94 years. The British pound sterling cycle, 1914 to 2008, 94 years. The US dollar's gold-backed cycle, 1879 to 1973, 94 years. The clock is not metaphorical. It is mathematical. And the modern fiat US dollar, born in 1971, is at Stage 4, the debt spiral. It is year 80. We are in the final phase of the countdown. History's stopwatch is ticking. You cannot reset it. You cannot ignore it. You can only understand it. This is what comes next. To understand the end of a cycle, you must first see its peak, the height of absolute monetary dominion. By 1945, the United States held the world by the economic throat. It produced 50% of global GDP. It held 80% of the world's official gold reserves. Fort Knox was not a symbol. It was the vault of the planet. The Bretton Woods system in 1944 didn't create dollar dominance. It formalized a victory already won on the battlefields and factory floors of World War II. For nations, using the dollar wasn't a choice. It was a necessity. To trade oil, to buy machinery, to rebuild, to participate in the modern world. The dollar was liquidity. The Federal Reserve wasn't just a national central bank. It became, de facto, the central bank of the world. This was Stage 1, the golden anchor. The promise was absolute. $1 equaled 1/35 of an ounce of gold. For any foreign government. No questions asked. Trust was not required. The math was real. The gold was there. The system worked with brutal efficiency for 2 decades. Global trade exploded under the dollar's clear rule. European and Asian economies rebuilt themselves on a flood of dollar-denominated credit and aid. The Marshall Plan, $13 billion. All in dollars. The world was dollarizing. But empires are expensive. Dominance has a price tag. Stage 2, Imperial Overstretch began immediately. The Cold War. Korea. Vietnam. The global network of military bases. From 750 bases in 1950 to to over 1,000 by 1970. The Great Society social programs, guns and butter, all funded by the unique privilege of printing the world's reserve currency. The U.S. could run persistent trade deficits, sending dollars overseas, without immediate crisis. Other nations had to earn hard currency. America could print it. This was the exorbitant privilege famously noted by French Finance Minister Valéry Giscard d'Estaing. It was a drug, and the addiction was instant. The fatal flaw appeared in the ledger. To supply the world with dollars for trade, the U.S. had to run balance of payments deficits. But to maintain confidence in the dollar's gold peg, those deficits had to be controlled. It was a mathematical impossibility. The Triffin dilemma, predicted by economist Robert Triffin in 1960, was not a theory. It was a countdown. By the late 1960s, the countdown reached zero. Dollars held overseas, in European central banks, in Tokyo, in the Middle East, dwarfed the gold in Fort Knox. The U.S. had promised to back a growing global mountain of paper with a finite, physical stockpile. The promise was broken before it was formally renounced. Foreign governments knew it. They began quietly exchanging their dollars for gold. America's gold reserves plummeted, from a peak of 20,000 metric tons in 1950 to just over 8,000 by 1970. The fatal decision was not a matter of if, but when and how. It came on August 15, 1971. Nixon closed the gold window. The temporary measure. The world was told the dollar was strong. The move was to defend the dollar against speculators. The truth was simple. America could no longer honor its promise. The golden anchor was cut loose. This was stage 3, the fatal decoupling. The global monetary system was now based on pure faith. Faith in the U.S. government's promise to manage its currency responsibly. Faith in its political stability. Faith in its military to enforce the order. The dollar was no longer a claim on a real asset. It was a claim on the future productivity of the American economy and the power of the American state. They told you it was a necessary modernization of the financial system. The truth was, it was a unilateral default on a global promise. The world had no choice but to accept it. The 94-year clock for the fiat dollar started ticking that night. The cycle was now in motion. The pattern, set in stone by history, had its newest subject. Stage 1, the golden anchor. Every dominant currency begins with tangible, unassailable value. It solves a crisis of trust. It becomes the indispensable tool for global trade. Historical example 1, the Spanish silver real, cycle, 1590 to 1684. 1492 to 1550, New World silver discoveries flood Spain. The Peace of Eight, real becomes the first true global currency. 1590, the Spanish Empire formalizes the silver standard. 1 real contains a specific weight of pure silver from Potosí in Mexico. It is the currency of hemispheric trade, used from Manila to Madrid, Buenos Aires to Brussels. By 1600, Spain controls 85% of the world's silver production. The anchor, physical silver, universally valued. Trust is in the weight and purity of the metal, not the Spanish crown. Historical example 2, the British pound sterling gold standard cycle, 1717 to 1811, reserve cycle, 1914 to 2008. 1717, Sir Isaac Newton, as master of the mint, accidentally sets the pound to a de facto gold standard. Stability follows. 1816, the UK formally adopts the gold standard post-Napoleonic Wars. The pound is defined as 113 grains of pure gold. 1850 to 1914, the Pax Britannica. London is the world's banker. The gold-backed pound finances global railways, mines, and trade. Over 60% of world trade is invoiced in sterling. The anchor, gold convertibility at the Bank of England. As good as gold meant the British pound. Historical example 3, the US dollar gold-backed cycle, 1879 to 1973. 1879, the U.S. resumes gold convertibility after the Civil War's paper greenback experiment. 1944, Bretton Woods. The dollar is anointed the gold-backed reserve currency at $35 per ounce. 1950, The U.S. holds 20,000 metric tons of gold, roughly 80% of global monetary reserves. The anchor, the unwavering, legally binding promise. $35 for 1 ounce of gold for foreign governments. The pattern. Stage 1 lasts as long as the anchor holds. It creates a period of immense stability and global expansion for the issuing empire. The currency becomes a public good for the world, but a privileged weapon for the empire. Stage 2. The Imperial Overstretch. The privilege of issuing the world's money fuels geopolitical ambition. Military and social spending explode, funded by debt that the world is forced to absorb. Historical example 1. Spain, 1590 to 1684. The Silver Fleet pays for endless European wars. The Spanish Armada, 1588. The 30 Years' War, 1618 to 1648. Constant conflicts with France and England. Debt-to-revenue ratio explodes. By 1650, over 50% of all silver shipments from America are immediately seized by Genoese and German bankers to service debt. The empire controls the money, but foreign bankers control the debt. Military overreach destroys the real economy at home. Historical example 2. Britain, 1914 to 2008. World War I, 1914 to 1918, forces Britain off the gold standard. It prints sterling to fund the war. National debt soars from 25% to 135% of GDP. World War II, 1939 to 1945, completes the fiscal destruction. Debt hits 250% of GDP. The U.S. Lend-Lease Act is essentially a dollar bailout of the British Empire. The 1956 Suez Crisis proves the point. The U.S. threatens to sell British pound bonds, forcing a humiliating retreat. The military empire outlasts the financial means to support it. Historical example 3. The U.S. dollar, post-1944. The Cold War. The Vietnam War, $1 trillion cost in today's dollars. The global war on terror, estimated $8 trillion. The U.S. military budget equals that of the next 10 nations combined. A global network of 750-plus bases in 80 countries. The exorbitant privilege allows this. Since 1971, the U.S. has run a cumulative trade deficit of over $18 trillion. It exports dollars, imports goods, and projects power. The pattern. The reserve currency privilege masks fiscal insanity. The empire mistakes liquidity for solvency and global demand for its debt for infinite credit. The foundation begins to crack under the weight of ambition. Stage 3. The fatal decoupling. When the strain becomes too great, the anchor is cut loose. The link to tangible value is severed to preserve the empire in the short term. It is always framed as temporary. It is always permanent. Historical example 1. Spain, 1680s. By the 1660s, rampant debasement begins. The silver content of the real is secretly reduced to fund more wars. The discovery of widespread clipping and counterfeiting destroys trust. The physical anchor is corrupted. The value of the currency divorces from its metal content. The 1680 crisis, a collapse in confidence across European banking houses exposed to Spanish silver. The global real dies. Historical example 2. Britain, 1931 and 1949. 1931. The UK is forced permanently off the gold standard during the Great Depression. The pound devalues by 30%. 1949. A second massive devaluation, 30% against the dollar, as the sterling area crumbles. The pound's role as a stable store of value is shattered. The 1967 devaluation is the final nail. The Wilson government devalues from $2.80 to $2.40. Global confidence in British monetary management evaporates. Historical example 3. The U.S. dollar, 1971. August 15, 1971. Nixon closes the gold window. The Bretton Woods system collapses. The temporary measure becomes permanent. The dollar floats, backed by full faith and credit alone. This is the genesis of the current 94-year cycle. The clock started at zero. The fiat dollar era began. The pattern. Decoupling is an admission of failure. It is the moment the empire chooses to save itself by destroying the foundational trust of its currency. It buys time. It accelerates the countdown. Stage 4. The debt spiral. With the anchor gone, discipline vanishes. Debt becomes the only tool to maintain the empire and domestic stability. Money printing accelerates from a tool to a permanent policy. Inflation ceases to be cyclical and becomes structural. Historical example 1. Spain, post-1650. To service endless Habsburg War debt, the crown seizes private silver shipments and issues juros, government bonds, at unsustainable yields. The economy hollows out. Why produce when speculation on debt pays more? Spanish manufacturing and agriculture collapse. Massive inflation hits. Prices in Spain increase by over 400% in the 1600s. The influx of silver doesn't create wealth, it debases the currency. The spiral: borrow to pay interest on old debt. Debase the currency to create temporary liquidity. Destroy real economic capacity. Historical example 2. Britain, post-1945. The sterling area forces Britain to prop up failing former colonies' currencies to maintain pound dominance, draining reserves. Stop-go monetary policy fails. Unions demand inflationary wage hikes. The government prints to avoid social unrest. Debt mounts not for growth, but for survival. The 1970s see inflation peak at 25%. The UK is forced to seek an IMF bailout in 1976. The spiral: print to fund welfare and a shrunken empire. Trigger inflation and capital flight. Raise rates to defend the currency, crushing industry. Repeat. Historical example 3. The US dollar, post-1971. Federal debt, 1971. $398 billion, 35% of GDP. 2024, $34.7 trillion, 122% of GDP. The Federal Reserve's balance sheet, 2008, $900 billion. 2024, $7.4 trillion. Key trigger: the abandonment of any pretense of sound money. The 2008 financial crisis saw quantitative easing, QE, become policy. 2020 COVID response saw $6 trillion in fiscal and monetary stimulus in 24 months, monetizing debt on an unprecedented scale. The spiral: crisis hits. Print money to bail out the financial system and stimulate the economy. Inflate asset bubbles, stocks, housing. Inequality soars. A new, larger crisis emerges. Print even more. The pattern: stage 4 is the point of no return. The currency issuer attempts to solve every economic and social problem with liquidity. The debt cannot be paid off. It can only be serviced with more debt or inflated away. The world, still holding this currency as reserves, watches the value of its holdings erode. Resentment builds. Stage 5. The collapse of confidence. The final stage is not an economic event. It is a geopolitical one. Foreign holders, seeing their reserves evaporate and their trust betrayed, stage a silent run. A rival power offers an alternative. The transition is chaotic, but inevitable. Historical example 1. Spain, 1680 to 1684. The Great Mutation of 1680 to 1686. European banks and trading houses finally refuse Spanish silver reals for large-scale settlement. They shift to the more reliable Dutch guilder and, increasingly, gold-based currencies. Spain loses its financial sovereignty. It becomes an economic backwater, its global currency reduced to coinage for local trade. The collapse is complete by 1684. The 94-year cycle from dominance to irrelevance is sealed. Historical example 2. Britain, 1992 to 2008. The 1992 Black Wednesday. George Soros breaks the Bank of England. The pound is forced out of the European exchange rate mechanism. A $3.4 billion loss in one day proves the UK can no longer defend its currency. The final blow: the 2008 global financial crisis. London is the epicenter of the crisis. The UK banking system requires a $1 trillion bailout. The world realizes the UK is not a safe haven. The pound's share of global reserves plummets from 65% in 1950 to under 4% by 2020. The 94-year reserve cycle, 1914 to 2008, ends not with a bang, but with the whimpering admission that the financial center of the old empire is a systemic risk. Historical example 3. The U.S. dollar, 1879 to 1973. The previous dollar cycle ended with stage 5 in 1971 to 1973. The world lost confidence in America's ability to redeem dollars for gold. A chaotic float ensued. Stagflation gripped the 1970s. The dollar index fell by over 30%. The crisis was only solved by the Volcker shock, 1979 to 1982, raising rates to 20%, inducing a brutal recession, and re-establishing confidence in the new fiat dollar by sheer force of monetary pain. It was a reset, not a reversal of the cycle. The pattern, stage 5, is a loss of monopoly power. Foreign central banks and investors diversify. Trade deals are struck in other currencies. Sanctions using the dollar as a weapon accelerate the search for alternatives. A new monetary system, often backed by a tangible asset or a new geopolitical alliance, emerges from the sidelines. The old currency becomes one among many, its privileges gone forever. The historical pattern is not a curiosity. It is a blueprint, and the modern fiat US dollar is following it, stage for stage, with chilling precision. We are here, stage 4. The debt spiral. The year is 2024. The dollar is in year 80 of its 94-year lifespan. The final, volatile chapters are being written in real time. The evidence is not hidden. It is in the raw numbers that define our financial reality. Current evidence, the spiral in data. The unpayable debt, U.S. national debt, $34.7 trillion. It took 200 years to reach the first trillion. The 34th trillion was added in just the last few months of 2023. Debt to GDP now exceeds 122%, a level only seen during the total war mobilization of World War II. But this time, there is no post-war demobilization planned. The trajectory is straight up. Monetization as policy, the Federal Reserve. 2008, it held $0.9 trillion in assets. 2024, it holds $7.4 trillion. After a brief attempt at quantitative tightening, it resumed expanding its balance sheet during the 2023 regional banking crisis. The message is clear. The Fed will print to prevent any major financial institution from failing. The debt will be monetized. Structural inflation arrives, 2021 to 2024. The official narrative of transitory inflation shattered. Core CPI remains stubbornly above the 2% target for over 3 consecutive years. Real inflation, measured by pre-1980s methodology, runs multiples higher. Wages chase prices in a damaging feedback loop. This is not a blip. This is stage 4 hallmark. Inflation becomes embedded in the economy's expectations. The loss of fiscal control. The U.S. government now spends over $2 billion per day just on net interest payments on the national debt. By 2025, the Congressional Budget Office projects interest costs will exceed defense spending. The nation is borrowing to pay the interest on its borrowing. This is the definition of a terminal debt spiral. Accelerated de-dollarization. Global central bank holdings of U.S. dollars as reserves have fallen from 73% in 2001 to 58% in 2023. The 15-point drop is the largest decline in history. Russia, China, India, Saudi Arabia, Brazil, all are conducting bilateral trade in non-dollar currencies. The BRICS bloc is explicitly building alternative financial infrastructure. The catalyst, 2022. A single year crystallized the transition from late-stage privilege to visible decline. 2022. February 24, 2022. Russia invades Ukraine. The West responds with the financial nuclear option, freezing $300 billion of Russian central bank assets and cutting Russian banks from SWIFT. They told you it was a righteous demonstration of dollar power. The truth is, it was the single greatest advertisement for de-dollarization ever created. Every nation not explicitly aligned with Washington saw the lesson. Your dollar reserves are not your property. They are a political weapon pointed at your head. If you cross U.S. foreign policy, your wealth can be taken with a keystroke. The reaction was immediate and logical. Saudi Arabia openly discusses pricing oil in currencies other than dollars. China and Brazil sign a deal to settle trade in yuan and rial. India agrees to pay for Russian oil in UAE dirhams and rubles. Central bank gold buying hits a 55-year high in 2022 and again in 2023. They are fleeing to the one asset that cannot be sanctioned or printed. The world's financial map is being redrawn, not by ideology, but by survival instinct. The monopoly is over. Stage 4 indicators. You are living in the spiral. These are not abstractions. They are the symptoms you feel every day. The everything bubble. Since 1971, year 1, the S&P 500, adjusted for real inflation, is up roughly 400%. Since 2009, it is up over 500%. This is not organic growth. This is currency debasement inflating asset prices. Wealth is not created. It is transferred to asset holders from cash savers. The erosion of savings. $100 in 1971 is worth less than $15 in purchasing power today. The dollar has lost 85% of its value in its own 94-year cycle. In the last 3 years alone, it lost over 15%. The geopolitical signal. The petrodollar agreement with Saudi Arabia, the bedrock of global dollar demand since 1974, is fracturing. When oil is no longer exclusively sold for dollars, the structural demand for trillions of dollar reserves vanishes. The Trust Barometer. A 2023 global survey by the Official Monetary and Financial Institutions Forum found 75% of central bank reserve managers believe the dollar's share of reserves will fall below 55% within the next decade. They are the insiders. They are voting with their portfolios. The policy trap. The U.S. is now stuck. To fight inflation, the Fed must raise rates and keep them high. But high rates make the $34 trillion debt service unsustainable and risk triggering a market crash. To save the debtors, they must cut rates and print, reigniting inflation. There is no exit. This is the final, defining trap of Stage 4. The clock is not slowing down. The spiral is accelerating. We are not at the beginning of the end. We are deep in the final act. This is not a forecast of a distant future. It is the mapping of an active process. The collapse of a global reserve currency is not an event. It is a cascade. It rewires the global economy. It redistributes wealth and power on a scale unseen for generations. History tells us exactly who wins, who loses, and what the road looks like. What this means. For the winners, holders of hard assets, those who own land, productive farmland, critical mineral resources, and above all, gold, will see their wealth preserved and then magnified. Gold is the eternal extinguisher of currency risk. During Britain's 1949 devaluation, the pound fell 30%. The gold price in pounds soared 43%. When faith in paper fails, tangible assets reclaim their premium. Creditor nations with alternatives, China, with its manufacturing dominance and push for yuan settlement. Resource-rich nations like Russia and Saudi Arabia, trading commodities for goods directly. They will shed dollar dependency, reduce their vulnerability to sanctions, and gain immense geopolitical leverage. Their currencies may not become the new reserve, but they will escape the coming devaluation trap. The new financial architects, the entities that build and control the alternative system, whether a digital currency platform, a gold-backed trade clearing mechanism, or a multilateral blockchain ledger, will inherit the transactional power that currently flows through Wall Street and the City of London. History's precedent. When the pound sterling collapsed, the winners were the United States, which positioned the dollar as the solution, and Switzerland, which maintained gold convertibility and became a safe haven vault for global capital. For the losers, the American middle class, the largest holders of dollar-denominated savings, bonds, and fixed pensions. Their wealth will be eviscerated by inflation and devaluation. The social contract, funded by cheap debt, will break. Expect means testing of entitlements, brutal inflation-adjusted benefit cuts, and a dramatic decline in living standards. Nations and corporations holding massive dollar debt. Countries with dollar-denominated sovereign debt will face impossible repayment burdens as their local currencies collapse against a still strong, initially, dollar during the crisis. Corporate junk bond markets will seize. The U.S. government's spending power, the ability to fund global military bases, sanction adversaries at will, and run unlimited deficits will vanish. The empire retrenches not by choice, but by mathematical necessity. The exorbitant privilege becomes an exorbitant burden. The entire dollar-based financial ecosystem, from Wall Street investment banks that profit from dollar centrality, to the SWIFT messaging system, to the eurodollar market, the entire infrastructure of dollar supremacy becomes a legacy system, a shrinking pond for stranded whales. History's precedent. When Spain's real collapsed, the Spanish Habsburg Empire bankrupted its own aristocracy and merchant class. When Britain's pound collapsed, the UK endured decades of austerity, IMF bailouts, and a permanent reduction to second-tier power status. Projected timeline, the final 14 years. Based on the compression of modern financial cycles and the historical 94-year average, here is the probable trajectory. 2024 to 2030, the acceleration of the spiral stage for intensifies. The U.S. will experience rolling, embedded inflation between 4 to 7%, officially. Real rates higher. The Fed will be trapped. Attempts to tighten will cause immediate financial crises, like March 2023. It will be forced to resume QE, explicitly monetizing Treasury debt. A major, coordinated de-dollarization event will occur. Example, Saudi Arabia formally prices a significant oil contract in yuan or a digital currency. This will trigger a sharp, volatile drop in dollar demand. Gold will break to new nominal highs, surpassing $3,000 per oz as institutional and central bank buying becomes a flood. 2030 to 2035, the collapse of confidence, stage 5 begins. A sovereign debt crisis hits a major Western nation, not necessarily the U.S. first. The response, massive, coordinated global printing, will be the final signal. The U.S. Treasury market will experience a buyer's strike. Foreign central banks will be net sellers. The Fed will become the permanent buyer of last resort, cementing the perception of pure monetization. A formal, parallel global trade and financial system will emerge, led by a coalition of BRICS plus nations. It will use a basket of currencies, gold, or a new digital unit of account. The dollar will experience a sudden, severe devaluation, a 20 to 30% drop against a basket of commodities and alternative currencies within a short period. Capital controls become a serious discussion in Washington. 2035-2040 plus, the new system emerges. The world operates in a bimonetary or multi-monetary system for a chaotic decade. No single currency holds over 50% of reserves. The U.S. is forced into a brutal fiscal adjustment, dramatic spending cuts, potential debt restructuring, and a deep, lasting reduction in its global footprint. A new anchor is established. It will not look like 1944. It could be a global digital currency tied to a commodity basket, IMF's special drawing rights reimagined, or a return to a gold standard for international settlement among central banks. By 2040 to 2045, the transition is complete. The 94-year fiat dollar cycle, 1971 to 2065, will likely have reached its terminal point earlier due to the accelerated pace of information and crisis. The pattern is clear. The numbers do not lie. The 94-year currency life cycle is a historical law as reliable as any in economics. It has governed the Spanish real, the British pound, and the gold-backed dollar. It now governs the fiat dollar. The question is not if. The trajectory is locked. The debt cannot be repaid. The trust cannot be fully restored. The monopoly cannot be regained. The only question is when and how violent the transition will be. The timeline, 14 years, give or take. We are in the final sixth of the countdown. Every financial decision made from this point forward, Every investment, every savings plan, every geopolitical bet must be viewed through this lens. History's stopwatch is ticking. You are living through the final act of the greatest monetary empire in history. Understand the pattern. Position for the transition. The cycle always wins. The 94-year cycle is not destiny written in stone. It is a pattern etched by human decisions, by the relentless choice of short-term political ease over long-term monetary discipline, by empires that believed their privilege was eternal. The clock ticks for every system built on faith without foundation. The fiat dollar's time is running out. The countdown from Bretton Woods to the Nixon shock to the debt spiral. It has all followed the script. Stage 4 is accelerating. Stage 5 awaits. You have a choice. You can watch the numbers rise on a screen, denominated in a currency being systematically devalued. Or you can understand history's most brutal financial lesson. When the music of a reserve currency stops, the scramble for real value begins. Don't listen to the promises. Watch the pattern. Follow the flows. Protect yourself. The cycle always wins. The only question is, will you? This video is for educational and informational purposes only. It presents historical analysis, opinions, and interpretations based on publicly available sources. It is not financial advice, political advice, or a prediction of future events. All historical comparisons and references to modern countries or governments are theoretical and should not be interpreted as claims, certainties, or endorsements. Viewers are encouraged to research independently and draw their own conclusions.